Good morning. Welcome to the B.F. Anderson Technical Report for December the 5th. You know, technical analysis is everything to do with mathematical facts. Human opinions, such as, political things or various opinions, don't really matter very much. Now, what we're doing here is we're doing something called trend following. The trend is your friend, is the saying on Wall Street. Basically, I've got a series of indicators here that I wanted to review as we go through them, just to kind of give you a little bit of background. Now, this particular indicator involves the use of the Nasdaq. Now, the indicator actually uses 5 indexes, but in this case, because of time, I'm going to just use the Nasdaq. But we go into other indexes as well. Now, the way this indicator works is you have 2 moving averages. You have the 25-day moving average and you have the 50-day moving average. As long as the index, meaning the Nasdaq, stays above the lower moving average and the lower moving average is moving up, that indicator is on a buy signal. So here we have the Nasdaq. As of today, it's a fact for me, a mathematical fact, that it is on a buy signal. Now, then we jump to more of an intermediate term type indicator, which is where we're looking at a weekly calculation of the Nasdaq. So you can see here that the Nasdaq has been rallying. This is the 35-week moving average. The rule here is that if we trade, like back here, if the market drops below this moving average and stays there for 2 consecutive weeks, each bar represents a week. If you stay below the 35-week for 2 weeks, that's a sell signal. But as you can see now, we are on a buy signal here. The only thing I would say about this particular graph is there still is quite a bit of white space in here. So, the market has been trying to correct this week. It has maybe gotten a little bit extended. Now, this is a new indicator that we are using that I think is important. Now, it is a ratio. So some of these indicators are just straight indexes. Some of these indicators are ratios. Now, this is a ratio where we're comparing the Nasdaq to consumer staples stocks, meaning risk on, risk off. In other words, people are, if they feel strongly about the market, they're going to be buying technology stocks. If they're worried about the market, they're going to be buying toothpaste and toilet paper stocks. And it's interesting to note how these two interact with each other. And it does give you an indication. Now, my point here would be is back in 2014, we went into a period. Now, remember, when the ratio is going up, technology stocks and, the Nasdaq is doing better than the staples. Well, you can see here that starting in 2014, right at the beginning of the year, we went through a real difficult period here for growth stocks. And then it got real difficult, which was somewhat of a shakeout in early 16, but boom, then we launched a growth stock cycle that went from 2016 low to a high in around June of 2018. So you can see here that this particular indicator showed up. You should be very aggressive in here investing in growth stocks. Now, this all peaked out back in 18. We came down, made a low, and then we've been pretty much moving sideways ever since. Now, you can see here as the most recent calculation that it has the ratio has pulled back, but here's how this particular ratio works. You are above the lower moving average, and the lower moving average has turned up. So this particular indicator is saying you should be emphasizing growth stocks. Now, this is a long-term indicator. I got this indicator from Louise Yamada, who's a fairly famous indicator. Now, this is another indicator. This is the number of new lows on the New York Stock Exchange. The rule there is we don't want to see the blue line here, we don't want to see more than 40 new lows on the New York Stock Exchange per day for a couple of weeks. Now, it's starting to settle down. You can see we only had 9 yesterday. Now, here's Louise Yamada's indicator. I apologize for that. This is where we're taking a 10-month moving average and we're comparing it to a 20-month moving average. Now, this is a long-term indicator. Now, the way this particular indicator works is golden cross, bear cross. We got a golden cross on this particular indicator in late 16, and then it has pretty much continued. And as long as you do not get a crossing of these moving averages, so on this particular indicator, it is on a buy signal. Now, this is not an indicator. This is just an index, but I like to look at it because it kind of tells you what's going on worldwide. This is the global Dow. You can see here that we've just kind of been moving sideways really since that peak back in 18, which actually it peaked around January of 18. Pretty much, pulled back, major pullback, held the trend line. However, it's trying and it's struggling, but the international picture has not improved dramatically. Now, this is the Value Line Geometric Index. Again, this is not an indicator, it's just an index. However, it's an important index because it is not market cap weighted. In other words, things like the Nasdaq and the S&P, the bigger the company in the index, the more influence it has on the index. Well, this particular index is equally weighted. So you've got 1,700 stocks in this index, which are all equally weighted. And you can see that it has really pretty much been stuck in a trading range, for a pretty extended period of time here. Now, we would really like to see this one get going. This is an important index. Now, here's a new indicator that I wanted to introduce. I got this week, in fact, from a guy named Jeffrey Sott, and he is the former chief investment statistician for Raymond James and Company. And he was on CNBC this week talking about the golden cross of the small cap stocks. So what I have here is the Russell 2000 ETF, which is now showing a golden cross where it is it's basically what's happening here is you've got the 50-day moving average moving above the 200-day moving average. And you can go back and look at history here and see, you got the buy signal back in 2012, and this is the index down here, and you got a nice upturn. You got a golden cross here, and there's just a nice rally, a nice move here. So we've gotten the golden cross on the small caps. And, I really hate to say this, but the real opportunity in the market is small companies. I mean, just think of it logically. If you can find a small company that becomes a big company, that to me is somewhat exciting. And we haven't seen this in a while. These small caps have been pretty much moving sideways. Really, I mean, they haven't made a new high, so they made their peak back in 18 and just haven't gone anywhere during the year of 19. And so there's some real opportunity here in the small cap stocks. Now, this is the mid cap index, just trying to show the same thing. We've got the 50-day and the 200-day. We've gotten the golden cross on the mid caps. These are the middle-sized companies. Now, let's get into the top 5 just to try to understand where are the strongest stocks in my database. Now, we use a database that covers about 3,700 stocks, and then we boil it down to about 70 stocks, and then I'm just showing you the top 5. Now, this is Analyn Pharmaceuticals. So I have noticed, and I mentioned last week, that the healthcare stocks are continuing to look good. And that's just one example. Now, here's another healthcare stock. In fact, this morning it's up pretty strongly to an all-time new high. This is Dexcom. You can see here they announced earnings, big gap up in the earnings, nice ascending flag formation. This stock really looks good, and we own the stock, and it's been a real good performer for us. This is Fortinet, which has to do with security software. Again, you got the gap up, the rally. It is somewhat kind of rolling over here. And I will say that the software stocks and the typical technology stocks, meaning semiconductors, software, enterprise software, cybersecurity software, these stocks have been having a pretty difficult time. I think I would be very cautious there. This is Qorvo, which is semiconductors. They, again, are involved in the 5G technology. The stock broke out and pretty much has been moving sideways. A little bit of a dip in here last couple of days ago. It looks okay. I think there are better looking patterns. Now here is, with growth stocks, you got 3 categories. You've got technology, you've got healthcare, and you've got retail. Those are the primary 3 groups. Now, Target is looking really strong here. A report came out yesterday saying that they're doing quite well. Stock is acting well. So all in all, what I'm saying here is that the small caps are starting to show some life. This is very positive because if you think about it, it's kind of a risk-on type of thing. People to buy the small caps have to take more risk than buying, the large cap companies. So if you have any questions, please give me a call. Thank you very much.